Welcome back to the deep dive. Today we're looking at something pretty big happening in the crypto market. Specifically, that recent sharp drop in Bitcoin's price hit a 4-week low. Now, on the surface, maybe it looks like just another volatile swing, right? But the sources we have suggest there's maybe something deeper, more structural going on.
Exactly. That's our mission today, really, to look beyond just the price chart flickering up and down. We're unpacking this move, yeah, Bitcoin dipping under $109,000, but not just what happened. We're digging into why, using some specialized on-chain analysis. We've got insights from Glassnode, 10x Research, trying to get at the core mechanics here.
And that price signal itself, I mean, it definitely caught people's attention. Dropping to $108,700 on Coinbase. That's, firmly below that $112,000 level everyone watches. A key support.
Right. And the initial take is that this signals potential market exhaustion. That's the term analysts are using. It wasn't just a random flash crash. Seems more like a structured retreat. And it looks like it's driven by, well, two main things we can measure. First, you've got the long-term holders, the LTHs, finally taking some serious profits. Massive amounts, actually. And second, and this is interesting, a real slowdown in those ETF inflows, especially right after the Fed rate cut last week.
Wait, hold on. The Fed cutting rates, usually that signals easier money,
Yeah.
right? More risk on. Why would that lead to a slowdown in ETF demand? Seems a bit backward.
Yeah, it does seem counterintuitive on the surface, but it's likely about timing and, expectations. See, when the Fed cuts rates, sure, it can boost liquidity. But a lot of institutions probably already positioned for that. They front-ran the decision. So once the cut actually happened, some of that anticipated flow maybe just dried up. The catalyst was already priced in, essentially. It created a bit of a vacuum, right, as these long-term guys decided, okay, time to cash in.
Okay, that makes more sense. So let's unpack that first point then, the profit taking by long-term holders.
Yeah.
What does this exhaustion actually look like in the numbers? It sounds like more than just, regular selling.
Oh, it is. The scale is really the key here. We're talking about the most patient investors, the LTHs, holding for over 155 days, riding out the storms. These holders realized a cumulative profit on, get this, 3.4 million Bitcoin this cycle.
Wow. 3.4 million Bitcoin. How does that stack up historically? Is that like 2021 levels?
It's absolutely comparable. It's hit a really critical historical point. Glassnode's data, it shows this level of LTH profit taking matches previous major market cycle tops. If you look at their specific realized profit loss ratio metric, profit taking spikes where over 90% of coins moved were in profit. We've seen that 3 times this cycle, and we just came off the third peak.
Right. Okay. And that historical context is crucial, isn't it? Because if these huge profit peaks usually mark the top.
That's the implication, yeah. Historically, these moments signal saturation. The really patient money, the bedrock holders, they've decided it's time to sell. So the conclusion from these analysts, based on that history, is that probabilities favor a cooling phase ahead. Think about the energy needed for that huge rally we saw. It took immense capital, huge enthusiasm. Now a lot of that energy has been spent, realized as profit.
So if we need a way to picture this market fatigue, it's almost like the market's a marathon runner, right? They had that incredible surge of energy, the big bull run, but now the fuel tank, the LTH conviction is running low. They've hit the wall. They're slowing down, need to rest, need that cooling phase you mentioned before maybe another run can even start. The energy just went into taking those massive gains.
That's a great analogy. It captures that macro dynamic really well, but the picture gets a bit more worrying when we zoom in. Beyond the long-term, guys, how are the short-term players reacting right now? And that's where we look at these other metrics, these stress indicators like SOPR and NUPL.
Okay, SOPR first. Spend output profit ratio. Sounds technical, but what's it telling us in simple terms?
Basically, SOPR looks at whether coins being sold today are selling for more or less than what they were bought for. So if SOPR is above 1, people are selling at a profit on average, below 1 at a loss. The symptom right now, SOPR is showing that some holders are starting to sell at a loss. That's a sign of, well, significant market stress. The ratio itself is hovering right around 1.01, just barely in profit.
And why is 1.01 dangerous? Isn't barely profitable better than losing?
It is, but it's about the trend and the context. In a strong bull market, if SOPR dips below 1, it often means the sellers are exhausted, washed out. It can actually signal a bottom is near. But in a correction, or what might become a bigger downturn, when SOPR struggles to stay above 1 or gets rejected there, that often signals more downside is coming. People are basically jumping ship the moment they break even.
Okay, so it shows a lack of conviction. They're not holding for bigger gains, just getting out as soon as they're not losing money.
Precisely. It suggests an opportunistic exit mentality, not a buy and hold one. And that stress gets amplified when we look at the other metric. STHNUPL, that's the short-term holder net unrealized profit loss. And it's getting really close to zero.
Right, the short-term holders,
Yeah.
the newer money. NUPL nearing zero sounds bad. What does that mean practically?
STHNUPL tracks the overall profit or loss for coins held less than 155 days. When it approaches zero, it means the average short-term holder is basically at break-even or about to go into the red. This is sort of the last line of defense before potential panic.
They have no cushion left. They're right on the edge or underwater.
Exactly. And the risk here, Glassstone points this out, is that NUPL hitting zero often triggers liquidations. Newer holders tend to quickly cut their losses. If the price slips just a bit more, they move from break-even into actual loss, and historically they don't stick around, they rush for the exits.
Okay, let's use an analogy here to make that threat clear. The short-term holder situation. It's like a game of musical chairs, isn't it? The music is playing, price is okay. But when the music stops, the price drops suddenly below their break-even who scrambles for a chair. It's the newest players, the short-term holders. They jump out fast, cut their losses before things get worse. They're the most likely to panic sell.
That's it, exactly. That rush for the exit is what can cascade, break down those support levels we talked about. So, okay, we connect this LTH exhaustion, this short-term stress. What's the overall outlook from the analysts? And here, things get interesting because there isn't total agreement.
Yeah, it seems like we have a few different camps forming. The first is definitely leaning bearish, based on this historical on-chain stuff.
Right. That's largely the Glassnode perspective. They basically concluded that unless we see a big, fresh wave of demand from institutions, from other holders stepping up pretty quickly, then the risk of deeper cooling remains high. They see the current structure as strongly resembling exhaustion. For them, that LTH profit-taking pattern is just too strong a signal to ignore.
But hang on, how much weight can we put on historical parallels this cycle? We have the ETFs now. That's a totally new factor, isn't it? Could that change the game?
And that's the million-dollar question, isn't it? It's precisely why you see a more neutral stance from others, like 10x Research. Marcus Thielen, their head of research, basically said they're staying neutral for now. They actually think a correction would be less surprising than a big Q4 rally right now, but they're not fully buying into the exhaustion guarantees a crash idea either.
So Glassnode is trusting the coin history. 10x is being more cautious, watching the current price action. What's their key level? What makes them turn positive?
Their line in the sand is $115,000. They said they'll only turn bullish if Bitcoin can decisively reclaim that level. That would signal demand is back. Below that, they remain concerned about more downside.
And that ties back to the $107,500 level we saw tested earlier.
Correct. The price is sort of flirting with that level again, the low from September 1st. If we break down below $107,500 properly, 10x Research worries that could trigger another wave of stop-loss selling. That's the technical danger zone.
But then there's the other side, the optimistic view. We heard from Michael Saylor earlier this week, right? He sounded pretty bullish.
Yeah, you can't ignore that perspective. Saylor expressed real optimism, basically predicting Bitcoin will make strong gains in Q4. His view seems to be that once these broader macro worries like the Fed uncertainty fade a bit, the institutional demand story kicks back in.
Yeah.
He likely sees this current weakness as just temporary noise before the next leg up, driven by that larger adoption trend.
So it's a clash of narratives. On-chain history screaming exhaustion. Technical analysis saying watch this level, and macro optimism saying the big picture is still bullish.
It really is a battle between, the micro data of coin behavior versus the macro belief in ongoing institutional flows.
Okay, so wrapping this up, what does it all mean for you, the listener? We've laid out the data. 3.4 million BTC profit taken by LTHs. Stress signs like SOPR near 1, NUPL near 0, clear signals of potential cycle exhaustion.
Yeah, the key takeaway, I think, is that this recent price drop isn't just random volatility. There are structural forces rooted in historical patterns at play. That LTH profit-taking is real, that short-term holder stress is measurable. It means maybe that buying aggressively right now carries a bit more structural risk than it might have, say, 6 months ago. The strong hands have lightened their load significantly.
And it leaves us with a really provocative question, doesn't it? If Saylor's right, maybe the macro institution wave is strong enough to overcome this historical on-chain exhaustion signal. But if the on-chain data patterns hold true, as they have in the past, does that mean the old cycle rules are still in charge, even with ETFs in the mix? Which story wins out? That's definitely what we'll be watching in the coming weeks. Is $107,500 the floor, or the start of that next wave of selling. Anyway, if you found this deep dive useful, please do follow, like, and share the show. It really helps. And for more insights like this, make sure you're following What Bitcoin Taught Me. We're on Twitter, X, Nostr, Blue Sky, Threads, Instagram, Facebook, and LinkedIn. Thanks for diving deep with us today.